Hello, everybody, and welcome to the Like a Tortoise channel and to our latest video on whether or not I will be selling Ulta Beauty. And this follows on from our previous video that was also about Ulta Beauty. They reported a tremendous earnings report, as you know, and so the question that I've been thinking, well, what I had to reassess is whether I should be selling my cells or not. And I want to talk about that here today. But before I do that, thank you so much again for all the feedback, for your great comments. They are really very insightful. I'm in that journey as well, so I keep learning as you guys keep sharing that information with me, and I definitely appreciate that. So, and if you are new here, much welcome. We are all about buying high quality companies with a significant margin of safety, which is something that sets us apart from other channels. They are many other people will typically call themselves quality investors. They buy at what they call fair value. We think that's expensive. We like to buy high quality when it's marked down. Okay, so the question I've been asked is whether I'm selling my Ulta Beauty shares or not. And for those of you who don't know, I started buying Ulta Beauty. I I always share. I use eToro for educational purposes again. Okay, so remember, So I don't. How can I say? I always use interactive brokers to execute all of my transactions, but I use eToro because the visuals are user friendly, right? So it's easier for someone who's just getting started to start well to just look at a platform like eToro compared to that compared to interactive brokers. Okay, and that's why I have an account with eToro. So I want to show you what I have here. This is the price that I pay that I paid for Ulta Beauty shares, about 330. Don't look. It's not that I caught the bottom. It's impossible to predict where the bottom will be, and you know that I'm not. My strategy is 9% fundamentals and 10% technicals. So whenever I look at the charts, I already know that I want to buy the company and I know which price to pay. But that price was about 330, right? My minimum, and it really coincidentally, of course, as you can see, it matched this strong line of support going back all the way to 2019. And so my goal was to keep accumulating shares if this thing continued to roll over. Unfortunately, that was not the case. And so I only opened a relatively small position here in this thing, and then the company reported earnings 2 days after, and the stock jumped, and I never got chance to turn my investment into a full investment. And now look where we are. Okay, it's been going straight up on the back of strong reports and outlooks. Okay, so the question is, should I sell my shares in the company given that the stock is up? What? Let's have a look. Almost 19% from where I bought it. Okay, and it's this 90% increase was only happened since look from March 2025 to now December 9th. So it happened in a short period of time, which is exactly what typically happens when you buy a high quality company when it's significantly underpriced. And that was the case for Ulta Beauty when I was accumulating shares. It was the lowest valuation the company had ever traded at in its history. Okay. And this has been a phenomenal compounder going back many years. And these are the kind of investments that I love, guys. All right. It's not investments that hardly grow their revenues or their margins are shrinking. So no, I don't like any of that. If I show you the financials of Ulta Beauty, for example, you can see that going back to 2017, revenues have been growing at 11%. If I look at net income has been going up by 14%. You look at earnings per share going up by almost 19% because they are a cannibal company. They have significantly decreased the shares outstanding over the last many years. Look at that, about 25% since 2017. great company, and they have a new management team. And in my opinion, I think Kecia Steelman is doing an amazing job as a CEO. And but now let's go back to the main topic of this video. Okay, this was just to set the tone for the call. Now, is it expensive? Do I think the company is expensive? If I go here to metrics, let's discuss Ulta on a relative basis. Look what happens to for example, to the PE ratio. Where is this PE ratio over time? That's the price to earnings. Okay, so right now, um, the price to earnings, is this the price to earnings? Really? No, no way. The PE is about 22. And if I go here, Ulta Beauty, so let's have a look. Let's flip this to the trailing 12 months. Exactly. So look at that. Let's not include the 2020 because these are like COVID time. In fact, 2021, these are definitely outliers. So let's just exclude that. But you can see that the PE right now is trading at its highest level since 2024, and certainly one of the highest levels in since one of the highest levels in the company history. But look at that. So the average, this is important, okay? The median P is about 22. Right now we are at 19. The average sits at about 26, yeah, since 2017. So, I mean, is the company expensive? No. Is it more moderately priced? I would say yes. Certainly not cheap, not by my standards. Let's have a look at the price to operating cash flow. The company has been doing some investments to now that they are expanding into other markets outside the United States. So let's use price to operating cash flow. Look at that. Okay, very high. The only time it was this high was back in 2023, but still the average is about 17. The medium is 16. We are at about 17.60. So on a price to operating cash flows, I mean, we are there. All right. It's not egregiously overpriced. I mean, certainly not, but it's certainly not cheap. And so let's keep with those two metrics. And what happens is, in fact, um, uh, if I show you other metrics, this is a company that most retailers, guys, are actually struggling to keep sales going up. And many of them are seeing their sales contracting. In other words, they are losing business. Ulta Beauty is doing the exact opposite, all right, which is something that I really like. It comes back to the quality of the business, as I already discussed. And sure enough, you can see that, for example, look what happens. Look what's happening. Let's go to financials and let's go to ratios. Look what happened to the returns on invested capital. They are still at 20.31, right? Declining, but remember that the company is investing a lot now into growth. They have been doing so certainly under Steelman. Okay, that's why we are seeing more pressure here, but still it remains above 20%. Look at the return on assets, same thing, and the return on equity, very high as well. So all these things are above 10, my preferred measure of 10, 15%, my preferred threshold. So I like to see that. Okay. But now let's discuss the intrinsic value of the company and whether that has been achieved or not. Okay, so let's discuss that. For those of you who don't know the valuation process that I like to follow, please go back to my previous videos and I discuss I discuss all of them. I like to use a combination of DCF with other metrics that I learned from Fieldtown. And those are the ones that I will be honing in on today's video. Okay. So the margin of safety, which is explained by Fieldtown as well. This one is more suitable for companies that are growing much faster, like 15 and above 15% per year. That is not the case for Ulta Beauty. Analysts are projecting future growth of about 9%. Okay. And so I don't think these, you can see that earnings per share has grown at about 15, 22% over the past 5 and 10 years, respectively. But I I want to be conservative here, and so I stuck with analyst's call here, and I used 90% as my growth assumptions. And so it's well below 15, which explains why the margin of safety price is so low. So let's not use this, which is not suitable. But the ones we will be using is payback time and the 10 cap rate owner earnings, right? Payback time, guys, tells us how long do I need to, how long, if you were to buy the entire Ulta Beauty company today, so the entire business today, how long will it take me to get my money out of the business in free cash flows? That's what this is all about. So we are going to be using free cash flows here instead of earnings. And remember, we this both these models methods have a 50% margin of safety already built in. Typically, an average S&P 500 company takes 16 years to has a P of around an average P over time of around 16 times. That's the average for the S&P over the last many decades. And so we want to get our money out of the business in 8 years. Okay, so we have a 50% margin of safety. How the hell do I do that? Look, here's zero. We're going to use Ulta Beauty's current free cash flow. Okay, so if I go here to the financials and go to cash flows, you can see that the trailing 12-month figure is about 1 billion. Now, an important thing to mention here is that the company is investing a lot into growth. Okay, and so I could adjust the free cash flow by adding back the growth capex. Okay, so if they are doing, for example, 370 million in capex, we could use, for example, the depreciation and amortization as a proxy for maintenance capex, and I would be using the excellent amount. I would be adding that to free cash flows, but I'm not going to do that because it's small, okay, and let's be conservative. So I will be using this figure right here, and that's the figure that you can see right here. All right. So now what I'm going to do is I'm going to grow the free cash flow in 01 at about 9%, which is my projected growth rate for the next 10 years. And I will compound that free cash flow at those 9%. And then I will sum up all those free cash flows from year 1 to year 8. And that means the sum of all the free cash flows is about 12 billion and a half. And then you only have to do this 12 billion and a half divided by the number of outstanding shares, and that will give you the free cash flow in year 8 payback time price, which is 278. Now, what did I tell you? This already has a 50% margin of safety built in. Okay, which means that according to the payback time price, the real value of Ulta Beauty sits at around 556. And right now the stock is trading at 594. So we are past that. Okay, so the fair value is already past that. And what this means is that if you want to take our money out of the business in free cash flow in about 8 years, this is the price per share you should be paying. Okay. Now, if I do the same, but instead of free cash flow, I use earnings. Yeah, you can see that the payback time. You can see that the payback time instead of the payback time price instead of 278 is 317. Why is that? Exactly because the company is doing capex investments. All right. And so, which means that the free cash flow metric that I'm using here is actually a bit flawed in that I should be adding back that growth capex, but it's not that much. And sure enough, the difference is not that significant. If I use the 10 cap rate, yeah, this was adapted from real estate. As you know, we start with in this one, unlike the buyback time and the margin of safety price, does not include any growth assumptions. So you could make the case that this one is the most conservative one. We start with operating cash flows. We subtract maintenance capex from total capex. and then we add the tax provision, and that will lead us that will that will and then with those metrics we can figure out the total owner earnings, where we just do the operating cash flow minus maintenance capex, and we add the tax provision. That gives us the total owner earnings, which we then divide by the number of outstanding shares to get this the owner earnings per share, and that's about 33.76. Now if you multiply this by 10, you get 337.58. 337. What does that mean? It means that if you buy Ulta Beauty at this price, that essentially is the price that coincides with 10% of the company's market cap. So you have a significant margin of safety, right? It's huge, guys, because it means this doesn't even factor in any future growth. Okay, so it's like a 10% yield, which is quite substantial. And sure enough, what was the price I paid for Ulta Beauty? It was exactly, yeah, around those levels at the time. So I had that big margin of safety, as I always do love, and well, we are now off to the races. So this means that based on the 10 cap rate, our the real value of the company is around 674, okay, which is a bit higher than our free cash flows, our free cash flow payback time price, and a bit higher than our earnings 8-year payback time price. What do I like to do when I have these three numbers? I like to add them up and then divide it by 3 to come to a price that I'm comfortable paying. And if you do that, so if we do 337 plus 317 plus 278, we do this, and then if I divide this by 3, you get about 311. 300, what am I doing? Divided by 3, yeah, so if you do that divided by 3, you get about 310, okay, and now 310 multiplied by 2, you get about 620, exactly. So this is the intrinsic value of Ulta Beauty, if you ask me, and you can see that we are practically at that level, okay. Now all of this is important because I want to say that if I were a core value investor, I would be selling my shares right now. Okay. But I'm not a core value investor. A core value investor, typically a hardcore value investor, will trade quite often. You will buy a great, not necessarily great company, okay, but then you will buy it at a big discount, and then you will sell it once that value is already, once the market reprices it. But I'm different in that I'm a value investor, so I still like to buy with a big margin of safety, but I'm also a quality investor because I like to hold only high quality companies, and I would like to hold them for the long term. Not many companies fit the bill, meet my criteria for outstanding. And so if I sell the shares of not Lulu, sorry, of Ulta Beauty today, then I would have to find another attractive opportunity. Not many companies will offer me the kind of growth prospects that Ulta Beauty gives me today. This is a company that only started its expansion into the world fairly recently. They have been stuck in the United States for a very long time, and now they are expanding. Okay, they are going overseas, and I still think the runway for growth can be quite meaningful. Not only that, I still think the company will continue to buy back a lot of their shares, which means they will continue to deliver a lot of shareholder value over time. And I love what the new management team is doing. Okay, so to sum it up, no, I'm not selling my shares because number one, I think the stock is at intrinsic value. So I don't think the stock is egregiously expensive, not even close. And so I'm not selling my shares. Okay, and that's what I wanted to say with today's video. So I do hope that you guys, I hope that you manage to take some important teachings, some important learnings away from this call, and this is what I'm doing. So I'm sitting tight, I'm holding tightly, I'm not selling my shares unless this thing just becomes egregiously expensive. But I don't think that will be the case, okay? Exactly because it's not a tech name. Many people will look at this and will find it like it's a boring company. And so yeah, I'm gonna sit comfortably here. I'm gonna wait, and I'm just gonna ride out any volatility that may indeed appear without any regrets, because I understand what I own. I love what the company is doing. And remember, at the end of the day, what we own is a business. What matters is the long term. Is this company going to continue to create value over time? Do I think Ulta Beauty is going to be in a better position in the next 5 or 10 years? And if the answer is yes, I mean, why would you sell? Okay, unless you saw a ridiculously, like an egregiously expensive looking price. Okay, so yeah, this is it, guys. So smash the like button, please, if you did find it helpful, and don't forget, guys, that I'm holding my first live event. I'm sharing this right now on the 20th. Is it on the 20th? Yes, so it's already next week, on the 20th of December. So yeah, join me. You can ask me anything regarding investments, my personal life background, whatever you guys want. And for those of you who cannot attend this for any particular reason, I'm also hosting another event that I'm sharing with you guys here on LinkedIn. And you can see that this is the first live webinar as well of like a tortoise, which will take place on December 18th. So yeah, try to join one of these, and I would love to meet you all. And stay safe, and yeah, stay tuned for more.